finally we have come to this, the discounted cash flow analysis, which is kind of like the highlight of financial modeling. So far we've practiced Excel skill sets, we've practiced shortcuts, and then we moved on to, most of you probably have moved on to Modeling 101 class, and we have built up these three statement models. Some of you might have already studied trading or transaction comparables first, and then came to this DCF section. But anyhow, I cannot stress this enough. DCF valuation is the highlight of financial modeling, and in broader terms, valuations in a whole sense. So let's just explain to you the concept of DCF valuations, which I feel that most of you who are listening to this lecture already have a basic sense of what DCF is. But anyways, the concept of DCF valuations is that you are going to become an investor. You don't know if you're going to become a creditor, you don't know if you're going to be a shareholder, but an investor in general. And you're looking at the company and you're trying to figure out how much money I want to invest in this company. And what you want to know is how much money or cash you can take from this individual company's cash flow. So how much cash you can take from this company, all cash after the company pays off its labor costs, marketing costs, R&D costs, and then taxes to the government. And after paying, after spending money for capital expenditures and investment in working capital. So every, expenses or cash outflows that the company needs to spend in order for the company to maintain as in the long term. So that's, in other words, called free cash flow, which we're going to be looking at just in a moment once again. And you're projecting how much money you can take from the company, so free cash flow. But you can't project, forever, because the company has a going concern, and usually we're assuming that a company goes on forever. But you can't forecast the cash flow for forever, right? Only forecasting 5 years was difficult enough for us in our Financial 101 class. So usually we have a limit. So we forecast for maybe 5 years or 10 years, and then after then we give we set up a certain big assumption, and we try to calculate the other parts of the forecast periods in a very simple manner. So the years that you have projected, the years that we have analyzed, studied, and actually projected are going to be part one of the DCF valuation. So part one, calculating the present value of explicit free cash flow. But the other part number two, which we will be using very simple assumptions to derive 6 years after and beyond, this would be part two. So deriving the present value of terminal value. It's called terminal value because it's in the end. For the free cash flow for part one, we have already pretty much done everything. All we have to do is now link the individual accounts to free cash flow, so calculate free cash flow. So we have already put in so much effort to calculating these free cash flows. But what we have to do here is to calculate the terminal value and to study also the concepts and the methodologies of calculating terminal value. So free cash flow, we're going to be looking at it just in a moment. But before that, let's briefly see the pros and cons of DCF valuations. One of the biggest pros of DCF valuations is that it actually calculates the intrinsic value of the corporate. And by intrinsic value, we mean that we're trying to figure out the real value of the company that's not affected by any external, market situations or how your peers are doing, how the market is doing. We're not going to be affected by any of those external influences. We're just looking at the company itself. So by doing DCF valuations, we can know the true value of the specific company. That's one of the biggest advantages of DCF valuations. Another big pro is that even in situations when you cannot use comparable valuations, which are typically situations where the company is having losses or they have very uncertain performances, or they're in their very beginning of their business cycle and so on. Even in those kind of situations, usually DCF valuation can be applied to most of the companies. So it has a much more broader usage compared to other valuation methodologies. So that's another pro. Number three, by forecasting future cash flow of the target, so we are actually putting in a lot of effort to forecasting future cash flow. So we can analyze the target from various angles. So such as we can perform scenario analysis. So for example, if you're doing a valuation for a casino company, how COVID-19 would be recovered is going to be a crucial factor in the business plan. So we're setting up three scenarios, for example. So number one scenario, if COVID ends earlier than we expected, that's going to be a bull case. There's going to be a base case, and lastly, there's going to be a bear case where we're expecting that COVID-19 just goes throughout maybe for the next 5 or 10 years. So that's going to be the worst case. So we can analyze the company or the company's value in various scenarios where you cannot, or where it's very difficult to predict. So that's the very one of the biggest advantages of DCF valuations. Lastly, it does not become affected by the volatility of the market. So this is a pro and a con at the same time. Because it does not be affected by volatility, it means that it truly values the true value of the company. However, on the other hand, a con is that it does not reflect market situations. Market situations are also very important when you're raising capital or trying to sell or buy a specific company. That's market situations are also important, but when you're doing DCF valuations, it's very difficult to capture that market situation when you're doing DCF. So that's going to be a con. Other disadvantages of DCF valuations is, number one, there are just too many assumptions that are going to be required. So we're going to make a whole lot of assumptions, including future cash flow, terminal value, weighted average cost of capital, and etc. And also, this is just like a textbook disadvantage of DCF valuations. People have, this is psychology, and people tend to have a exceedingly optimistic view of the company when it comes to, projecting cash flow. So what happens is, usually when you're doing DCF valuations, the valuations tend to be overstated a lot. So sometimes I agree. In some point, I don't really agree with this point, but this is like a textbook disadvantage of DCF valuations. Personally, I think, it's not because of psychology, but I think it's more because of needs. Usually people have needs for, higher valuations in order to, make an actual investment. So in your mind, usually in the investor's mind, he or she usually before doing DCF, he or she has, a will to invest or not. And usually when you're even starting to do DCF valuations, usually in your mind somewhere, you want to invest in this company. So you're just praying, oh, let's please, let the valuations be, reasonable. And maybe that's one of the reasons why when you're doing DCF valuations, you try to, make the company value bigger and, you just drift off from being absolutely objective. And then we have another thing. DCF valuations are very complex and difficult and also time consuming. So if you have any experience doing any comparables valuations, I think you will find DCF valuations much more time consuming, and you have so many things that you have to take care and truly deeply think about. So that would be one of the cons of DCF. This is a typical DCF model. Usually we have components of the DCF. And then we have a separate column for assumptions. So we need many assumptions for DCF valuations, like terminal growth rates, a weighted average cost of capital. If you're doing a 10-year DCF where you only have projected for 5 years yet, when you're extending your forecast years, you need big chunks of assumptions just to extend your forecast periods. So we need a tab for assumptions. Number 3, we have we usually calculate the present value factor. So we're going to be explaining this when we get to our Excel spreadsheet. Lastly, there's a column for actual valuation. So we're deriving enterprise value, and then we're calculating equity value, and lastly we're going to be calculating equity value per share, because that's what you really want to know. So our goal here on DCF valuations is trying to figure out the per share value, so the per share value of equity value of fill and talks, which we have been studying over and over for the past few hours.